Trading company accounting is a branch of accounting that studies recording, summarizing and reporting transactions that occur in companies that buy merchandise for later resale. The main objective of trading company accounting is to produce accurate and relevant financial information for various interested parties, such as owners, management, creditors and investors. There are several characteristics of a trading company, namely: 1. The company's main income comes from sales of merchandise. 2. The company's main costs come from the cost of goods sold and other business costs. 3. The main goal of the company is to make a profit from selling merchandise at a price higher than the purchase price. 4. There is a merchandise inventory account in the company's accounting. 5. Act as an intermediary between producers and consumers. Basic concepts of trading company accounting. 1. Inventory. Merchandise that the company owns and is ready to sell. 2. Cost of goods sold, COGS. Direct costs related to the production or purchase of merchandise that has been sold. 3. Gross profit. The difference between net sales and cost of goods sold. 4. Operational expenses. All costs incurred in carrying out the company's operational activities, other than the cost of goods sold. 5. Net profit. The difference between gross profit and operating expenses. Accounting cycle. 1. Transaction identification. The initial stage is to identify all transactions that occurred within the company during the accounting period. This transaction can be in the form of purchasing merchandise, selling goods, receiving payments, paying debts, and so on. 2. General journal. Each transaction that has been identified is then recorded in a general journal. The general journal is the first notebook that records all transactions chronologically. 3. Special journal. To make recording easier, certain transactions such as purchases, sales, cash and bank transactions are usually recorded in a special journal. 4. Subsidiary ledger. After being recorded in the journal, the transaction is transferred to the subsidiary ledger. The subsidiary ledger is used to record transactions per account in detail. 5. Posting to ledger. Data from the subsidiary ledger is then posted to the general ledger. The general ledger is a summary of all accounts in the company. 6. Cost of goods sold, COGS, report. The COGS report is used to calculate the cost of goods that have been sold. COGS is very important for calculating gross profit. 7. Creating a trial balance. A trial balance is created to check whether the total debits are equal to the total credits in the ledger. 8. Adjusting journal. Adjusting journals are created to record transactions that have not been recorded or need to be adjusted at the end of the period. Examples are depreciation of assets, unearned income, and accrued expenses. 9. Trial balance after adjustments. After adjusting journal entries are made, a trial balance is created again to ensure that all accounts have been adjusted. 10. Prepare financial reports. Based on the trial balance after adjustments, a financial report is prepared. Financial reports consist of a balance sheet, profit and loss statement, and cash flow statement. 11. Making closing journal. Closing entries are made to close all nominal accounts, income, expenses and profit and loss, and transfer the balances to the retained earnings account. 12. Post-closing trial balance. After the closing journal is made, the trial balance is created again to ensure that all nominal accounts have been closed. 13. Reversal journal. Optional, reversing entries are used to reverse certain adjusting entries, such as income that has been received in advance and expenses that have been paid in advance. Trading company financial reports balance sheet shows the company's financial position on a certain date, consisting of assets, liabilities and capital. Profit and loss statement shows the company's financial performance during a certain period, consisting of revenue, expenses and net profit. Capital changes report describes changes in owner's capital during a certain period. Cash flow statement shows cash inflows and outflows over a specific period. Then, there are several transactions that usually occur in a trading company, for example. 1. Purchase of merchandise, on credit or cash. 2. Purchase return. 3. Purchase transportation costs. 4. Purchase discount. 5. Sales of merchandise, on credit or cash. 6. Sales returns. 7. Sales deductions. Trading company accounts. 1. Purchase account is an account that is only used to accommodate purchasing activities for company merchandise. 2. Sales account is an account that is only used to accommodate sales of company merchandise. 3. The inventory account is to show the amount of merchandise the company has at the beginning or end of a certain accounting period. 4. Cost of goods sold, HPP, is used to accommodate the cost, purchase price of goods sold in an accounting period. 5. The sales discount, cash discount account is used to accommodate the amount of discount or reduction given by the seller to its customers, because they have paid in cash or within a predetermined time. 6. The sales returns account is used to accommodate a number of goods that have been sold but are returned by the buyer due to a discrepancy in the order. 7. The purchase discount account is used to accommodate a number of discounts given by the manufacturer, supplier to the buyer because they have paid in cash or within the specified time. 8. Marketing expenses are used to accommodate the overall expenses incurred by the company to sell and distribute its merchandise until it reaches consumers. Conclusion. Trading company accounting has a very important role in managing company finances. By understanding the basic concepts of trading company accounting, companies can make better business decisions and ensure business continuity.